For this session in your financial management, we will talk about your current asset management. So when we talk about asset management, it means the management of the various current assets. We learned before under working capital is equal to your current asset less your current liabilities. And when we say working capital management, you both manage current assets and current liabilities. The management of your current assets is known as your current asset management, and the management of current liabilities is known as your short-term financing or your short-term finance. And sometimes it's known as your AP management. So for this session, our main focus is the management of your current assets, particularly the management of your cash, the management of your marketable securities, including the management of your inventory. So let's start. We discuss first your management of cash. So cash management. The goal of cash management is to reduce the amount of cash that is being used within the firm so as to increase profitability that without reducing business activities or exposing the firm to undue risk in its financial obligations. Okay, you already know the concept of your working capital. So what we need to know in your cash management is you have enough cash to both cover your operations and at the same time you must have excess cash so that at least you can cover other business activities or it cannot expose the firm to injuries in its financial obligations. So aside from your operations, you must have enough cash to at least meet the business demands, including the different liabilities of the corporation. And we have already discussed this when we talk about your different working capital financing policy. So how do you really manage your working capital? Do you need just enough or do you need an excess or you just need to pair whatsoever? But in cash management, what is important is for us to have enough cash, both for our operations, that is to increase our profitability, also to pay off our liabilities, and of course, continue our business activities. So what are some management practices for cash? In this particular session, we will talk about different cash management techniques. So later you will meet the BOMOL model, the financial planning model. You also have your lockbox system. So these items we will discuss or different practices to manage your cash. So before we go with your management of cash, let's look into your different motives of holding cash. So there are actually four motives of holding cash. The first motive of holding cash is your transaction motive. So the firms hold cash in order to satisfy the cash inflow and cash outflow needs that they have. So normally for your transactional motive, this is more of your operational. So you hold your cash enough for your operations or for your transactions. Another motive of holding cash is your precautionary motive. This is what we say you must have an excess cash. So holding cash as a precaution serves as emergency fund for a firm. So only excess cash, you know that this is the amount of your cash needed for your transactions or your operations. You have an excess cash as an emergency fund for a firm. Another motive of holding cash is your compensating motive. So a minimum balance is required to be kept. Normally, in your compensating motive, this happens in case you have a loan. So under your contract of loan, you are required to maintain a certain amount of cash in the bank, which should not be touched or withdrawn during the term of the loan. We call that compensating motive or compensating balance. And the last motive of holding cash is your speculative motive. This one, unlike in your precautionary, this precautionary it's just enough or an excess amount in case you need to fund something. But in your speculative, you have enough cash. You have enough excess cash so that when there's opportunity, you can grab that opportunity. So here, you hold cash to create the ability for a firm to take advantage of special opportunities. So this one, the main reason is for taking advantage of special opportunities, while in your precautionary motive, the main reason is for any emergency fund purposes. Okay, so we have four motives: transactional, that is for operations; precautionary, for emergencies; compensating, for compensation or minimum balance; and last is speculative motive, enough cash for special opportunities. So those are different motives of holding cash. The motives of holding cash, of course, affects you on how you properly manage your cash. So are you more of speculative that you have too much cash? Or are you more of precautionary that you have only enough cash for emergency fund? Or you are purely transactional? So you can also combine different motives so long as we define your cash that is held by the company through these different motives. So it can either be transactional motive, precautionary, compensating, or a speculative motive. We go now to your management of cash. And the first technique in management of cash is your Bumal model. In your Bumal model, you have here a cash balance under certainty. So here, you just compute the enough cash balance that you maintain. Unlike in other motives, like you just need this amount without any explanation at all, this particular model gives you the amount of cash that is enough for you to maintain all of your operations or to maintain whatever you need to maintain. So under this formula, we have the square root of 2TD over I. So what does that mean? So OCB is your optimal cash balance. That is the amount of your cash balance that is held by the company. T is the transaction cost, which is normally the fixed amount per transaction. I is the interest rate on marketable securities or the cost of borrowing cash. And D is the total demand of cash over a period of time. So generally, this Bumol model wants you to equalize the cost of opportunity and the cost of transaction. When we say you equalize the cost of opportunity and the cost of transaction, this is the optimal amount of your cash that the transaction cost and the opportunity cost is equal. The transaction cost or the opportunity cost is equal. If you still remember your topic before in your cost accounting, especially your economic order quantity, that is your optimal amount of inventory. Here, we have your optimum cash balance or your Bumol model or OCB. This now gives you the optimal amount of your cash. If EOQ gives you the optimal amount of your inventory, OCB gives you, or Bumol model gives you the optimal amount of your cash. And again, when we say optimal, it tries to equalize both costs. What costs are equalized under the Bumol model? You equalize the opportunity and the transaction cost. Now, if you try to check to compute for your opportunity cost, that is equal to your average OCB multiplied by your rate of return, while your transaction cost is equal to your demand divided by OCB times cost per transaction. And if you try to look at it, the amount of your opportunity and your transaction later on when you use your OCB will be equal. Okay, let's try to have an example. For the coming years, the expected cash disbursement total is 432,000. The interest rate on marketable securities is 5% per annum, and the fixed cost of selling marketable securities is pesos per transaction. Compute the optimal cash balance to minimize the cost. Okay, so when we say minimize the cost, again, we equalize both transaction cost and your opportunity cost. So our formula for your ViewMall model is we have your 2 TD over I. Okay, so the square root of 2 multiplied by your transaction cost. Our transaction cost is 8 pesos multiplied by your total demand, which is 432,000, divided by the interest rate, which is 5%. So our optimal cash balance is equal to, we compute our optimal cash balance, 2 multiplied by 8 multiplied by 432,000 divided by 5%, square root of that answer, our optimal cash balance is 11,757.55. Okay. Now we compute for your opportunity cost. So for our opportunity cost, what we do is we get for your average cash balance and we multiply it to your rate. Okay. So we have here OCB divided by 2 multiplied by 5%. Okay. So OCB, our OCB is 11,757.55 divided by 2 multiplied by 5%. This will give us 293.94. Okay, that is our opportunity cost. Next, we compute for our transaction cost. For our transaction cost, this is equal to your total demand of cash all over your OCB multiplied by your cost per transaction. So multiplied by T. So we have here 432,000 divided by 11,757.55. Multiplied by your 8 per transaction. Okay? So 5% is our interest rate and 8 pesos is the transaction cost. So 432,000 divided by 11,757.55 multiplied by 8, you will get here 293.94. Okay, so what did we prove here under your view mall model? So you need at least 11,757.55 amount of cash per day. So at least to equalize your cost of your transaction and your opportunity cost. What is your opportunity cost? That is the cost that if ever you invest your cash into the market, that is the amount of your earning. While your transaction cost is, of course, your cost per transacting a particular cash. Now, what we have here is we try to equalize the cost together with the possible revenue. The possible revenue here is known as your opportunity cost. Why is it opportunity cost? It is a cost that has been let go because you choose another instance. In this case, we try to equalize it. We equalize both transaction or getting an expense and of course getting the rate or income. Okay, view model. So this gives us again your optimal amount of cash. So as you can see, if ever you will ask soon, what is the optimal cash balance? Your answer should have been 11,757.55. Next question is, what is the opportunity cost? Compute optimal cash balance divided by 2 multiplied by I. And then your transaction cost is your total demand of cash divided by OCB multiplied by your transaction. Okay, and focus that the amount of your transaction cost and opportunity cost is equal. Because again, Bumol model uh, takes cognizance of both opportunity and transaction costs. Another method of managing your cash is cash planning. So in your cash planning, we have here a cash budget or a cash forecast. This is a statement of the firm's planned inflows and outflows of cash that is used to estimate its short-term requirements. Typically, the cash budget is designed to cover a one-year period divided into smaller time intervals. The more seasonal and uncertain a firm's cash flows, the greater the number of intervals. But what is important here in your cash planning, you have here a cash budget, a planned amount of your inflows and outflows. So when we say planned amount of your inflows talks about your revenue collections or your collections, and your outflows talks about your different payment or disbursement. Okay, now how do we really plan your cash? So your planning of cash starts with a sales forecast. The sales forecast is a prediction of the sales activity during a given period based on external and or internal data. The sales forecast is then used as the basis for estimating the monthly cash flows that will result from projected sales and from outlays related to production, inventory, and sales. Okay, so normally guys, what happens here is we have here your sales forecast. Okay, so based on your sales forecast, you can already forecast the amount of your collections based on that sales forecast. Furthermore, sales forecast talks about the demand, right? Sales forecast talks about the demand. Since the sales forecast talks about the demand, what happens now is you must know how much or how many should you produce. Therefore, we are also talking about production. And when we talk about production, this talks about your inventory. So how much is your inventory and how much should you still produce? So starting from your sales forecast, again, it affects everything already. So in cash planning, generally the first step is for you to determine the sales forecast. Thereafter, determine the amount of your demand, and based on the demand, that is your production. Your production. And if you want to know your inflows, that is your collections out of that sales forecast. So how do we really plan? So first, we have your total cash receipts here. You place it your total cash receipts. Less total cash disbursement, you have your net cash flow. Net cash flow plus beginning cash, we have your ending cash. Okay. So your ending cash will be placed here. Okay. The ending cash of previous month is the beginning cash of the subsequent month. Okay. The ending cash of the previous month is the beginning cash of the subsequent month. So here, so you can see the ending cash here is the beginning cash of next month. Less minimum cash balance. This is based on your OCB, or if not OCB, it is either given. So ending cash less your OCB. If ever it is positive, you have excess cash balance. If negative, okay, again, you compare your ending cash, versus OCB. If your ending cash is greater than OCB, then you have excess amount. Okay? But if your ending cash is lesser than OCB, then you need financing. Sir, why do we need financing? So in our example a while back, how much again is the amount of our optimal cash balance? 11,000. 757, right? Okay. This is our optimal cash balance on top. So that is our minimum cash balance. So for example, your cash receipts is 90,000 and your disbursement is 83,000 and cash receipts, cash disbursements, and then we have your beginning cash of 7,000. Okay. You need this optimal cash balance to continue your operation. And furthermore, it equalizes the cost of both your transaction and opportunity cost. Now, using our formula, our total cash receipts as given is 90,000. Our cash disbursement is 83,000. Therefore, our net cash flow is 7,000. You add your beginning cash of 7,000, your ending cash is 14,000. So if your ending cash is 14,000 and then your OCB is 11,757, therefore we have an excess amount of cash. Okay? We have an excess amount of cash. But what if our cash receipt is 90,000, our cash disbursement is 83,000, our beginning cash is 2,000. Okay? What if it is like that? So our cash receipts is 90, less cash disbursement, less beginning cash. Our ending cash is 9,000. And our OCB is 11,757. Remember, this is the amount that is minimum. That is the minimum amount of your cash. So if that is your minimum amount of cash, meaning you are short with your operations. Because what you need for your normal operations is that 11,757. However, since your cash is only 9,000, therefore you are short by an amount equal to 2,757. So the question is, what will happen to the 2,757? The 2,000 shortage should be financed. So we call that your required total financing because you need 11,757, but you only have 9,000. So the 2,757 should be financed. Again, what's the concept of this minimum? That is the amount of your cash. That is your minimum amount of your cash. Therefore, if there is if the amount of your ending cash is lesser than that, you need a financing or you need to finance more either through long-term or short-term financing. Okay? Again, what's important with this cash planning? First, you need to determine your sales forecast, which also give you your cash receipts. From your sales forecast, it gives you the demand. In the demand, it gives you your production forecast, how much should you produce, how much should you buy, etc. The production, therefore, with the demand, give you your total disbursements, thereby giving you net cash flow. And then what is important here in your cash planning is that you need to determine if you are in excess of cash or you are short of cash. If you are short of cash, what should you do? Your decision is to finance, either through short-term or long-term finance. But you need to finance. Other cash management strategies. First, we have your accelerating collections. Of course, if you need enough cash, rather than guys financing, then you accelerate your collections. So when we say accelerate your collections, instead of collecting after the due date or beyond the due date, you try to collect earlier by enticing your customers to pay you earlier. Next, you slow down disbursement. When we say accelerating collections, then you can collect money or there's too much receipt. When we say slowing down disbursements, disbursement talks about your expenses. So here you delay as much your expense payment. Okay? You delay expense payment. And then lastly, you reduce precautionary idle cash. What is your precautionary idle cash? Again, your precautionary idle cash is for emergency purposes. Emergency purposes. Therefore, to properly manage your cash because you need enough cash, you could reduce that. Okay, so these are other strategies that aside from your financing. You can accelerate your collections by getting ahead of time your receivables, AR collection. Then we have your slowing disbursement. This is your delaying of expense payment. So here you delay your accounts payable. And in your reducing precautionary idle cash, what we do is to at least deduct or reduce your emergency purposes cash fund. Let's start with accelerating cash collection. So how do we accelerate cash collection? So the first one is your decentralized collections. So when we see decentralized collections, instead of a central collection authority wherein only one person can collect, you try to decentralize it. So for example, this is your business company, and then you have different branches. So branch 1, branch 2, branch 3, branch 4. So before, what you do is all payments will be directly to your business company. That is considered centralized. That is considered centralized. But if B1, B2, B3, and B4 can collect on their own, it will be now easier to collect because unlike before, it will be transferred to the main office. Now, all the branches can collect on their own their sales. Okay, so they can collect on their own. We call this one as decentralized operation. So instead of only one, you transfer now the operations or authority to other branches, which is branch 1, branch 2, branch 3, and branch 4. Okay? Another, lockbox system. So in your lockbox system, what we have here is of course, a lockbox. I don't know if you have seen a lockbox. This is already old. I don't know if it's still present right now, but actually it's really a box. It is a box with a lock. So you assume this is the lock. So what we have here is like a drop box. It is like a drop box wherein all collections will be dropped in that particular lockbox. Okay? So lockbox system. Later we will discuss that. Prompt payment by customers. Okay, so how to accelerate, of course, prompt payment by customers. How do we prompt your customers by paying early? By giving, of course, cash discount. Right? Giving cash discounts. That is for your prompt payment by customers. So remember, if you want a collection promptly, you can give cash discounts. Remember, there are two types of discounts that can either be cash discounts or trade discount. Trade discount is given for bulk buying, while cash discount is given for prompt payment. So if you want a prompt payment, how do you entice your customer to pay promptly? By giving them cash discounts. Next, early conversion of payment into cash. Okay. So if ever there is a payment, normally when we talk of payment, the payment is through a check. And check is not a cash. So what we need to do to accelerate our cash is, of course, to convert this payment or check now into cash. Because if you will not convert your payment into cash, then you don't have cash. Okay? So to accelerate cash collections, the following can be done. First, you then centralize your operations. So instead of a one central authority who can collect cash, it can now be the other branches, so other operating branches. Lockbox system, so it is a box wherein the customers can drop their payments into that box. Prompt payment by customers by giving cash discounts. Early conversion of payment into cash, that is your check, you now convert it into cash. Next here in your accelerating cash collections is the way to improve cash collections. So how can you improve cash collections? Actually, as you see, we are not already talking about cash only. We are not only talking about cash. Okay? We are also talking about AR because cash is tied with AR. How you manage your AR gives you cash. So as you can see, AR collection is actually cash collection. So that's why, as you can see, a while back in our introduction, I only talk about cash, marketable securities, and inventory. Because as we go through in your cash, we also talk about your management of your receivables. And that is in acceleration of your cash collection. Right? So ways to improve cash collection. You change your customer paying habits. So when we see changing customer paying habits, instead of paying always late, you try to change it by enticing them to pay earlier. Okay? So normally, soon when you are in your business, you see that there are really customers who pay late, and you want your best that at least they can pay earlier. So you try to change their paying habits by, of course, enticing them by giving higher cash discounts. Next, you improve the delivery system. When we say improve the delivery system, this talks about your lockbox system and your early conversion of payment into cash. So here, the problem is that from the time of payment, there is a float. When we say float, there is an excess day before you can convert that into cash. So for example, you have already collected the payment. However, you did not yet converted it into cash. Therefore, what you need to do is to improve your delivery system so that once there is payment, it should be automatically be converted into cash. So once you receive a check payment, then you try to convert that into cash. Lastly, you bypass the problem. When we say bypass the problem, in your changing customer paying habits, if you cannot let them pay earlier, then we cannot do otherwise. If ever they are paying on time, however, the problem is in the company wherein there is a lapse of time from the time you receive that payment up to the time it is deposited, then you need to improve your delivery system. But if ever the problem really is to the customer, you bypass the problem. When we say bypass the problem, instead that you collect that, you sell it. Factoring of receivable is the selling of receivable. So here, what you do now, you tried to collect, right? You tried to collect. However, there's no change if that problem here is the customer. Now, if ever you can collect on time, but you do not convert it on time, the problem here is the company. Therefore, what you need to do is to improve your delivery system. But if the problem really is the customer and you cannot collect, then what you need to do is to bypass the problem. Sir, how do I bypass the problem? By factoring the receivable. When we say factoring the receivable, you will now sell the receivable to other person. Then the sale or the amount of proceeds on the sale of that receivable now is used as your cash. Okay? So this is how we actually accelerate cash collections. By accelerating cash collections, we mean we properly manage our receivables. We go now to your lockbox system, which we have already mentioned. We said lockbox system is just like your box wherein a Dropbox wherein you drop there the amount of your payment. So a lockbox system is a procedure in which customers mail payments to a post office box that is emptied regularly by the firm's bank, which processes the payments and deposits them in the firm's account. So what happened here is that there is a drop box in the post office wherein the customers now will just place their payment on that drop box. And then finally, it will be deposited to the bank of the company. So what is the use of this? This system speeds up collection time. But actually, I told you this is already too old of a management of your cash because there's no one I know that still uses lockbox system. In this day and age wherein you can just transfer money in your fingertips, then I think lockbox system is already obsolete. However, we still discuss this because it's part of finance. Advantage, that is to receive remittances sooner, which reduces processing flow. Because what happens here before customer going to the company, and normally it takes time for the customer to mail it to a company. But if there is an intermediary, which is the lockbox, we have now a customer to the lockbox, and from lockbox to the company. It now reduces the time. Sir, why does it reduce the time? Because this one is always processed regularly by the bank. Okay? Disadvantage, there is of course a cost of your lockbox, and then there is also the maintenance of your lockbox. Therefore, in your lockbox system, the main decision here is implement if ever the advantage is greater than the cost, greater or equal to the cost. So the lockbox process. So customers are to mail their remittances on the lockbox. The bank picks up daily, and then the bank deposits to the bank, and the company receives the list. As I told you, aside instead of customer directly to the company, this one before it takes time because when you mail something before going to a particular person, it takes days. Okay, before nung unang panahon, yung mga mail natin umaabot yan ng 30 days before someone receives them. That's why it takes time. But now in your lockbox system, what happens is that in the place of the customer there is a box. This will be collected by the bank of the company, and then the bank of the company will directly place it into the company's bank account. So, mas madali na lang to. Kumbaga, one day na lang yung processing niya kasi nga magbabayad, kukunin niya ni bank, i-deposit niya doon sa account ng company. So, kung before, it takes 30 days, let's say now it can only take 10 days. That's the use of your lockbox system. But again, before implementing, you must compare advantage versus the cost. When we say cost, this is the cost of lockbox and at the same time, the cost of maintenance of the lockbox. So let's have an example. It takes ABC Corporation about 10 days to receive and deposit payments from customers. Therefore, a lockbox system is being considered. It is expected that the system will reduce the float time to 8 days. So from 10 days with the lockbox, it is now 8 days. Okay. The reduction in outstanding cash balance arising from implementing the lockbox system is, so before 10 days, now 8 days. And how much is the cash collection per day? 500,000. So that is 1 million pesos. The return that could be earned from this fund, so if we have 1 million, you multiply it to 12%, we have here 120,000. So you have 120,000 advantage. The maximum monthly charge the company should pay, so if you have annual income of 120,000 divided by 12, the maximum that you should pay is 10,000. Okay, so you should pay monthly 10,000. So this is the amount of your advantage. To accept it, the advantage we said should be greater or equal to your cost. So what is the maximum cost? The maximum cost should also be 120,000. But since they are asking for monthly, you divide that to 12, so we have here 10,000. So as you can see, it is equal. It is equal. So this is better. Sir, why is it even if equal, we accept a lockbox system? That is because even though there is no effect on your financials, there is effect into your operations. Sir, why is there an effect on your operations? Because before, you can only the collection is up to 10 days only, but now, because of your lockbox, it is 8 days, right? So the maximum amount, therefore, is 120,000 per year or 10,000 per month. But what if the total cost of the lockbox is 150,000? Will you accept it or not? Not anymore, because the advantage is only 120, but the cost now is 150. Therefore, do not accept the lockbox system. only accept the lockbox system if in case the advantage is greater than the cost. And as I said, even though we're talking about lockbox system, this is not already prevalent during our time because this is way before our time. But again, for purposes of finance, we talk about the acceleration of cash through a lockbox system. That is the decrease of the processing time of your cash. Another example, XYZ Corporation is exploring the use of lockbox system that will cost 100,000 per year. Daily collections average 350,000. The lockbox arrangement will reduce the float period by 2 days. The firm's rate of return is 15%. So we need to get the amount of your advantage. So to get for your advantage, of course, we get first for the reduction, which is 2 days, multiplied by the value per day, 350,000, and the amount of your return, which is 15%. Okay? 2 multiplied by 350,000 multiplied by 15% will give us 105,000. Okay, that is your advantage. And then what is the cost? 100,000. So what is our net advantage? Our net advantage is 5,000. Will you accept the lockbox? Yes. Why? Because you have an advantage. Right? So remember to test whether to accept or not a lockbox system, you need to determine if ever the advantage is greater than the cost. In this case, our advantage is greater than our cost. The advantage is, of course, earning interest at 15% based on the additional cash you will collect out of the lockbox system. So here you will collect 350,000 for a reduction of 2 days, therefore total of 700,000 times the 15%, we have 105,000. Lockbacks. So let's continue with another strategies in your management of cash, and that is your decelerating cash payments. So in decelerating cash payments, generally here we try to postpone our disbursement or we try to postpone the payment of our expenses. So if our problem really is the payment of our expenses, then we try to decelerate our cash payments. So how to decelerate your cash payment? First one is you're playing the float. Later, we will discuss what is a float and how will we play the float. Another is, of course, your control of disbursement by first giving these different types of disbursement accounts. But when we say control of disbursement, the most important thing that you need to take note here is sometimes when you pay as much, you can also pay using a post dated check. So although it is not considered the payment yet, but it shows good faith that you are willing to pay. And then lastly, you have your remote and control disbursement. In a remote and control disbursement, as the term such as remote and controlled. So only few disbursements that really needs to be paid should be paid. So you only control the amount of your disbursement. Let's discuss your float because this is one of the most important things that you need to learn in your decelerating your cash payments. So float refers to funds that have been sent by the payer but are not yet usable funds to the payee. Float is important in the cash conversion cycle because its presence lengthens both the firm's average collection period and its average payment period. However, the goal of the firm should be to shorten its average collection period and lengthen its average payment period. Both can be accomplished by managing flow. Okay, so dalawa lang naman kanina yung ating cash strategy, that is to accelerate cash collections and decelerate cash disbursement. Okay. So when we say accelerate cash collections, this should shorten collection period. See here, shorten its average collection period. And then decelerate cash disbursement lengthens average payment period. Okay. So as you can see, you can now tie up what you are learning before with what we are currently learning. So before we talk about your cash conversion cycle, that is from the time you have your cash and then you invest it and then you collect it and then you pay. Okay. So here in your cash conversion cycle, we need to manage that. And in managing that, we need to accelerate collections. That is to shorten your collection period. We call this one also AR management. And then we have your decelerate cash disbursement. This is to lengthen your average payment period. This is your AP management. Now we go first with the concept of flow before we tie it up with the concept of your cash conversion cycle. So float, as had been given in this particular slide, it refers to the funds that have been spent by the payer but are not yet usable funds to the payer. As I told you, when I say float, it is the lapse of time wherein from the time you have the payment, you cannot still make use of it. Remember when we said a while back, you receive a payment and then you need to deposit it so that you can have cash. So we call that a float. Now, we need to properly manage that float. And when we say we manage that float, we try to play with that float. We try to play with that float. When I say playing with the float, you know that there is a clearing time for payments, right? Uh, this is normally known as your clearing period. So, for example, you issue the check. It will take time before it can be cleared by the bank and it will appear into the bank statement of the payee. So when we try to play with the float, you know that the time in clearing the particular check is more than a particular period. You try to write that period. Okay, so for example, the float period is 10 days. Well, I know it's too long because today in banking practice, our float is only hours. It is not days. It is only hours. So let's say the float is 10 days. The float is 10 days. And then you have here a due. So today is June 3. You have here a due on June 15. But if you pay on June 10, you pay on June 10, you receive a cash discount. Okay. So today is June 3, right? And that is June 10. And that is June 15. So if you try to play with the float, you know the float is 10 days. You now pay on June 10. Okay? You now pay on June 10. And it can only be cleared by June 20. You played with the float in that case because you already received the cash discount. At the same time, you paid it on time. Furthermore, you know that it will still be placed on the 20th day, not on the 10th day. Okay? So by the time you make use of the clearing period properly, that you you use that clearing period to at least get the cash discount and at the same time to pay on time. Right? That's playing with the float. But to properly understand float, we need to understand the different components of a float. So what are the components of the float? First, you have your mail float. This is the delay of between payments in the mail and when it is received. So we have here payment up to the time it is received. We call this one your mail float. Next, we have your processing float. This is the time from the receive of the payment up to the time it is deposited. So receive and then deposit to the bank. We call this one your processing float. And then lastly, we have your clearing float. That is the time from the deposit up to the time it is already available to the firm. We call this one your clearing float. Okay. So when we try to play with the float, you try to understand this different processing time So at least you have in mind, this is the number of days before that before my check will be cleared. So I make use of that number of days to at least pay on time, and at the same time, I can also get a cash discount. Okay. So from the time of payment up to the time it is received, we have here your mail float. Okay. Who pays? It is the payment of the customer up to the time it is received, of course, by the company. And the company, upon receiving, will process that for deposit. So from the receipt to deposit, we call that your processing flow. And from deposit up to the time it is available, when we say it is available, it now appears into the bank statement of the company. We call that your clearing float. Okay, so we have three components of float. We have your mail float, processing float, and your clearing float. So in our example a while back, we only have an example based on a clearing float. But actually, when you try to play with the float, you play on all of these floats: mail, processing, and clearing float. So if you try to look at it, so from the time you receive, from the time this is the check, from the time the check is written up to the time you receive it, okay? From the time upon payment to your receipt, we call that mail float. From the time you receive up to the time you deposit, we call that processing float. From the time of deposit up to the time it is available for use, we call that clearing float. Okay. Processing float plus clearing float, processing float plus clearing float will give us your deposit float. Okay? And deposit float plus mail float will give us your collection float. Okay? So processing float plus clearing float will give us deposit float. Deposit float plus mail float will give us your collection float. When we say collection float, it is now from the time you receive the payment of the check up to the time it is available for use. Okay? So this period, up to this period, that is the time you receive payment up to the time it is available. What do we call that float? Collection float. Next, from the time you receive payment up to the time it is available, what do we call that float? It is known as your deposit float. That is your processing plus clearing float. Processing plus clearing float. Okay, let's talk about your types of float. First, we have your negative, and then second, we have your positive float. So when is there a negative float and when is there a positive float? So there is a negative float when the book balance exceeds the bank balance, which means that there is more cash tied up in the collection cycle and it earns a 0% rate of return. Okay, so why is it negative float? So for example, our book balance is 90,000. Our bank balance is one no 70,000. So meaning there is a float of 20,000. 20,000 is floating. That is the difference. This difference, this float, what we do here is a negative float, we try to minimize it. That negative float will be tried to minimize. So what we do here is, of course, we accelerate the processing time. So why is it called a negative float? Because this amount is already recorded. So for example, you have already received payment. Okay? You receive payment. However, it is not yet deposited to the bank, right? Because you have here 20,000 excess of your book but not yet presented in the bank. We call that negative float. Why? Because it is not yet in the bank. It means that there is nothing that is earning out of that float, because the money will only earn once it goes to your bank. But since it is not yet deposited to the bank, therefore it does not earn. It only has 0% rate of return. It only has 0% rate of return. We call that negative float. How about a positive float? Take note here, in your negative float, the book is greater than the bank. In a positive float, we have a bank is greater than the book. It appears when there is firm's bank balance exceeds book balance. Okay, so for example, our book balance is 90,000, but our bank balance is 120,000. So in short, you have disburse something. So there is a disbursement. So disbursement is still in our bank. So since the disbursement is still in our bank, it continues to earn. It continues to earn. So while it is not yet removed in the bank, it is still earning. Here, you have already collected it. Why is it negative? You have already collected a money, yet it does not earn. Here, you already disperse it, but even though you disperse it, there is still earning because it is still in the bank. That's why if the bank is greater than the book, it's known as positive because, yeah, you disperse. Imagine you disperse, but you're still earning based on that disbursement. But in negative float, you have already collection, but not yet earning out of that collection. That's why it's called negative. And this one is called positive float. Okay, so good cash management dictates that negative float will must be minimized, if not eliminated, and positive float must be maximized. What do we mean by positive float must be maximized again? You must always play with the float. You play with the float. So in disbursing money, you try to play with the float. In that case, there is a late appearance of a particular disbursement into our bank account. And while there is a late appearance of that amount into our bank account, our bank account continues to earn out of that late appeared disbursement. Disbursement and collection float. So float, again, we try to look into your firm's available balance versus your firm's book balance. It's always uh, bank versus book. So we have here another terms terms for your float. The first term here is a disbursement float. This is generated when the firm writes a check, causing decrease in the firm's book balance, but to change it available balance. And then we have your collection float, which is created when a firm receives a check, causing an increase in the firm's book balance, but no change in its available balance. Actually, I know you're finished with this in your AE 105. Normally, disbursement float is known as your outstanding checks, and collection float is known as your deposit in transit. And outstanding checks are considered positive float, while the deposits in transit are considered a negative float. So why is it positive float? Because again, uh, you already disbursed, however, it is not yet reflected in the bank. So your bank continues to earn out of that disbursement. Here, you have already collected, but it is not yet represented in the bank. Therefore, even though you have already collected, you cannot earn anything out of that particular collection because it is not yet in our bank account. Okay, disbursement and connection flow. So we have different flows that were discussed already. We have your mail float, processing float, clearing float, collection float, deposit float. So how do we measure the float? The size of the float is a function of both amount of pesos and the length of the delay involved. A common measure of float is your average daily float, and it is calculated by multiplying the amount of float multiplied by the number of days and divide that by the number of days in the particular period. So float multiplied by the number of days outstanding multiplied by the divided by the number of days in a period. So let's have an example. Consider company Z that has 500 of float outstanding for the first 12 days of the month and 750 outstanding for the last 19 days. So we have here 500 for the first 12 days and then 750 for the next 19 days. So how many periods? You have 12 plus 19. So what is your average daily float? So our average daily float is 500 times 12 plus 750 times 19 divided by 31 days. Our average daily float is 653.23 pesos. Okay? So this amount is tied up daily. So you need to minimize this. You need to minimize it. Next, we compute for the cost of float. So how do we determine the cost of float? The cost of float is simply the opportunity cost of not having the money in cash. At the very least, the firm could earn interest on that cash if it were available for investing. As I told you, the problem here in your collection float is that you have already collected. However, it is not yet appeared in the bank. Therefore, since it did not appear yet in the bank, it does not earn anything. So while it is not earning anything, we call that opportunity cost. Okay? Because you should have earned on that money. However, since it is not yet in the bank, you did not earn anything yet on that money. So that is called opportunity cost. That is the cost of float. So we just multiply the amount of your float multiplied by the interest or the opportunity cost. Okay, so we're done with your cash management. So remember in your cash management, generally first we talk about your BUMOL model, wherein we try to get the optimal amount of our cash. And then we talk about your financial planning or your cash planning, which starts from a sales forecast, and then determining whether you need an extra financing or you have an excess cash. Furthermore, we talk about your different strategies in your cash. We talk about your lockbox system. We talk about your accelerating of cash collections, and then deceleration of cash disbursements. So in your cash collections, we talk about your lockbox system and how do we make use of that lockbox system. Primarily, we need to compare the advantage out of the cost of the lockbox system. Furthermore, we also talk about your deceleration of cash disbursement, particularly the playing of the float. So we talk about the different types of float and how to properly make use of that particular float. Let's proceed to another current asset. Next, we have here your marketable securities. So when we try to manage your marketable securities, we have here your marketable securities management. So examples of marketable securities are your treasury bills. When we say treasury bills, these are securities issued by the government. So when you read treasuries, it means it is from the government. Commercial papers, certificate of deposits, and your bank deposits, these are all marketable securities. But the most marketable security right now is your T-bills together with your commercial papers. So how do we manage your marketable securities? So we manage your marketable securities using your Miller-Orr model. So under your Miller-Orr model, it assumes that net cash flows are normally distributed with a zero value of mean and a standard deviation. So here we have variances, we have daily return on your short-term investment and your minimum cash requirement. You already know what is your minimum cash requirement. That is normally your optimal cash balance or based on your BUMOL model. However, if there is no BUMOL model, sometimes the problem will give you your minimum cash requirement. But in our case, we will not now discuss your Miller-Orr model. Sir, why will we not discuss your Miller-Orr model? Because here it requires a cube root, and not all calculator has a cube root, especially basic calcu. Basic calcu does not have a cube root. Basic calculator does not have a cube root. That's why we will not discuss your Miller-Orr model. But again, whenever you are asked, how do you manage your marketable securities? Your best answer should be Miller-Orr model. Just tell them, You manage it using Miller or model. And what is the minimum cash requirements under your Miller or model? That is your OCB using your Bumol model. Okay, your Bumol model is like your EOQ. Please do not forget that. You try to maximize the amount of your cost of inventory together with your transaction costs. For inventory, your storage and transaction costs. For your cash, we have your opportunity costs and your transaction costs. Okay, we will not discuss your Miller or model. We will proceed now to another management of current asset, inventory management. So in your inventory management is the formulation and administration of plans and policies to efficiently and satisfactorily meet production and merchandising requirements and minimize costs relative to inventories. So there are three important things that is needed in your inventory management. The first thing is, of course, to efficiently fix your production and merchandising requirements. And then second is to your minimize costs. Remember in your cash a while back, what we need to look at is your how do we increase your profit out of your cash, so profitability, and at the same time your liquidity. We need to decrease your risk in case there is a true liability. So in your inventory management, we try to manage your inventory for efficient production requirements, merchandising requirements, at the same time, the minimization of your costs. Actually, you can divide this one to production requirements. The second one is merchandising requirements. Or you can also bring it together and call it production and merchandising requirements. Okay? So if there are motives for holding cash, there are also motives for holding inventory. So unlike in your cash, we have four. In your inventory, we have only three. So under cash, we add your compensatory motive or compensating motive. Here, there's no compensatory. We only have your transactional motive, precautionary, and speculative motive. First, transactional motive. This motive emphasizes the need to maintain inventories to facilitate smooth production and sales operations. Just remember, every time we talk about transactional motive, it talks about your operations or operational requirements. Precautionary motive is for your risk of unpredictable changes. So this is more of your excess in case there are changes. And then it's speculative motive to get hold of its opportunity. And what is the opportunity for your inventory? The opportunity is the price fluctuation. So in case the price is now too low, of course you buy more. The price is low, therefore you buy more. That's more of a speculative motive. Okay, so motive of holding inventory, they are almost the same with your cash, except that in cash, it is compensatory. So transactional is still operations, precautionary motive, that is for excess amount for any risk of changes, and speculative motive to get hold of your special opportunities, that is your price fluctuation. We go now with your economic order quantity. We will only run down your economic order quantity because I know you have discussed this already in your cost accounting. So how do we compute for EOQ again? Your EOQ is equal to your 2OD over C. Your O here is known as ordering cost. D is annual demand, and C is for your carrying costs. O is for transaction cost or ordering cost. C is for carrying cost or storage cost. So sometimes this is known as storage. This is known as your transaction cost. Okay. So remember in your economic order quantity, what we have here is we try to maximize again the cost of order and the cost of storage or carrying. Remember in your OCB, we also maximize two costs. Here, you also maximize two costs. And what are the costs? Cost of order and cost of storage. So I know you already know how to compute for your EOQ. And if ever you are asked what is the total order cost is equal to your demand divided by EOQ multiplied by ordering cost. While your carrying cost is equal to your average inventory multiplied by your carrying cost per unit. That is for your EOQ. So this is the optimal amount of your inventory, as I said a while back. In your OCB, optimal amount of cash. But in your EOQ, that is your optimal amount of inventory. Okay, let's just skip that. We go now to your reorder point. So reorder point is equal to your lead time in days multiplied by your daily usage. So this gives us idea on when to reorder. So actually you use your maximum lead time. Maximum lead time. Because actually reorder point is equal to safety stock plus minimum lead time multiplied by your daily usage. And safety stock here is equal to maximum less minimum multiplied by daily usage. So we have here, if we try to, okay, if we try to assess this particular formula, I said safety stock is equal to your maximum less minimum multiplied by daily usage. So we try to look into our formula wherein it is only maximum lead time times daily usage. So the order point is equal to your safety stock plus minimum lead time multiplied by daily usage. Assessing it further, the order point is equal to maximum lead time plus minimum lead time times daily usage plus minimum lead time times daily usage. So assessing it furthermore, you try to distribute maximum and minimum to daily usage. So you have here maximum times daily usage less minimum times daily usage plus minimum times daily usage. So as you see, plus and minus. Minus and plus, this will cancel out. Therefore, the order point will go back to our main formula, which is equal to your max multiplied by daily usage. Okay? So I know you know how to compute this already, but I just want you to learn why is it known as maximum lead time times daily usage. Because the order point goes back to your formula of your safety stock plus minimum times daily usage. And if you try to look into that formula, you can deduce that the order point really is only maximum times daily usage. Because coming from your safety stock, you have your maximum less minimum times daily usage plus minimum times daily usage. Eventually, you will only get maximum times daily usage. Therefore, if you are answering problems regarding reorder point, just get the maximum lead time and just multiply it to your daily usage. If the question is safety stock, get the maximum, you deduct the minimum multiplied by your daily usage. Okay? I know you know this because you have finished this in your cost accounting. And then we have also your ABC classification system. So ABC classification system, inventories are classified for selective control. So you try to classify them as either A items, B items, or C items depending on their control. So A items are high value items requiring highest possible control. B items are medium cost items requiring normal control. And C items are low cost items requiring simplest possible control. A item, high control. B item, normal control. And C item, simplest control. So normally, high-value items are in A items, B items are medium-cost items, and C items are low-cost items. So what is the control on high-value items? Highest possible control. What is the control in medium-cost items? Normal control. What is the control on C items or low-cost items? Simple possible control. So how do we do your ABC classification system? First, you find out the unit cost and the usage of each material over a given period. And then you try to multiply the unit cost by the estimated annual usage to obtain the net value. list out all the items and arrange them in descending value. And then you accumulate the value and add up number of items and calculate percentage on total inventory in value and in number. And then that's it, actually. So, medyo mahirap siyang intindihin based on the steps, but actually, when we look into an example, it is easier. Okay. So this is your item number, and then we have your unit cost. So A items are 20%, B items and C items are 40%. So first, we need to get for the total value. So to get for your total value, you need to multiply the unit cost to the annual demand. So we have here 5 times 48,000. We have 11 times 2,000. We have 15 times 300. And then we have 8 times 800. We have 7 times 4,800. We have 16 times 1,200. We have 20 times 18,000. We have 4 times 300. We have 9 times 5,000. We have 45,000. And then we have 12 times 600. 7,200. Okay, that's the first step. You need to get for the total value of each. So item 101, 102, 103, 104, 106 until 110. And then after that, you list them down in descending order. So when we say descending order, highest first. Okay, so what is the highest? The highest is, I think, 107 at 360,000. So item number 107. And then the next highest is, I think, 101. The next after 240,000 is, I think, 45,000, which is 109. And then the next after 45,000 is this 33,600, which is 105. The next after 33,600 is 22,000, which is 102. And then the sixth one, after 22,000, I think the next highest is 19,200, which is 106. And then the next to that is 7,200, which is 110. The next after 7,200 is 64, which is 104. And then we have 4,500, which is 103. And then the last one is 1,200, which is 108. Okay, so we list them down from highest to lowest. Okay, how many inventory items do we have? Inventory items, we have 10, right? 1 to 10. So we have 10 inventory items, inventory 101 until inventory 110. And then we classify it now, A, B, C. Sabi dito, 20% is A, so 20% of 10 is 2. So the top 2 here are A items. Clear? Top 2. The highest value, remember? The medium value, so 10. For B and C items, 40%. The next 4 is B items, so 3 until 6. So these are B items. And then lastly, C items, so 10 multiplied by 40%, we have again 4. So these are your B items again. A items, 107, 101, the top 2, based on the percentage. It is given here that you classify A items 20% of the total items, so 2, B and C for 40%. That's why we classified it. Actually, it's easy. You just need to get for the value, total value. You classify it as A, B, or C items. We classify it as either A, B, or C items. A, highest amount, B, medium amount, lowest amounts go to C items. And that's it for our current asset management. We talk about, again, your cash management. Please do not forget what we have talked about here. We discussed your Bumol model. We discussed also your forecasting or financial planning or your cash budget. We also discuss about your floats and your lockbox system. And when we went to your lockbox system, we also touch your accounts receivable management. Then later we have your marketable securities, that is your Miller or, and then your inventory management, which is your EOQ, together with your ABC classification. For your EOQ, I know you know how to compute for your EOQ already. I just emphasize the computation of your reorder point. And please do not forget how to compute for your order point. We have your lead time, maximum, and minimum. Lead time is the time from placing order up to the time you receive your order. Or in cash, we call that float. Okay, in cash, we call it float. In inventory, we call it lead time. But anyway, they have the same idea. There is a delay on the time you receive up to the time from the time you place it up to the time you receive it. Okay, so that's for your current asset management, cash management, marketable securities management, and your inventory management.